Margin is the amount of money that traders must deposit with their broker to be passed on to the clearinghouse when you open a position. It is similar in nature to a performance bond. Unlike futures margin, options margin is only required from traders who sell put or call options. It acts as a guarantee that should the option contract be exercised, the seller will be able to fulfill their obligations of the contract without default. Buyers of options do not have to deposit margin because the maximum risk is already known and is fully paid when purchasing the option as premium. Sellers of option contracts, however, can essentially be exposed to unlimited risk in exchange for a limited profit potential. For example, when selling a call option, no matter whether you hold the underlying asset, if the option is exercised, you are required to sell the asset to the contract holder at the strike price. You would then have to purchase it from the open market at the current market price, which could be a significantly higher price than the strike price of the option written, leading to a potentially large loss. Therefore, to protect against this risk, your broker will ensure you have a significant amount available in your account before you sell the options to allow you to fulfill your obligation. Margin requirements can vary based on the type of option or overall option strategy implemented. It is possible to write option contracts and use other assets as collateral instead of using cash to meet margin requirements. Examples of this could be covered calls and covered puts, where the trader owns the underlying asset, which can be used as collateral instead of cash. Trading other option structures can also offset margin requirements when including a sold option. The Standard Portfolio Analysis of Risk, known as SPAN, is the world's leading margin system, used by the majority of derivatives exchanges, including NZX. It is the method used to determine margin requirements for futures and options on futures. The margin model covers 99% of anticipated price changes for all products over a given period. The amount of margin is determined by a number of quantitative and qualitative factors, including historical data, annual or seasonal patterns, product liquidity, recent or anticipated events, and changes in market dynamics. Options margin is not fixed and is revalued daily based on changes in the premium of the options contract. For example, assume a trader has sold a call option receiving a premium of $100 per lot. The premium on that option rises by $40 to $140. The seller of the call option will need to provide more collateral into their broker account. Premium for NZX options is calculated using the Black 76 model. The Black 76 model considers several factors in its calculation, including the level of volatility, type of option, underlying futures price, time to expiry, strike price, and risk-free rate. Each day, when a short option position is margined, the impact of changes in each of these factors are combined to determine the net change in margin, if any. In general, if all other factors remain constant, then movement in individual factors influence the margin calculation in the following ways. An increase in volatility will increase margin required. A movement of the underlying futures price closer to or past an option's strike price will increase margin required. As time to expiry decreases, margin required will usually decrease for out of the money options and increase for in the money options. An increase in the risk-free rate will increase margin required. It is important to note a change in each factor can offset each other. For example, for an out-of-the-money option, decreasing time to expiry may reduce margin required, while increasing volatility may increase margin required, resulting in no net margin changes. Traders should determine the margin requirements for a trade before entering into it, to make sure they can meet those requirements if the market turns against them. Traders can do this by contacting their broker, or by utilising NZX's margin calculator tool to calculate the current margin for their portfolio, a specific trade or structure. This calculator can help users test different trading strategies across the suite of dairy derivative contracts to determine margin exposure and to help determine cash facility requirements. Note the margin calculator, however, only reflects NZX Clearing's margin requirement to participant brokers. There may be additional funds required from your broker. To learn more, including what is futures margin, please refer to our other educational videos at the link on screen.